Good morning, everyone, and thank you for joining me today for the Daily Moo Australia's morning roundup of the overnight action and what Asia Pacific investors might be facing today. I'm Michael McCarthy, CEO at Moo Australia, filling in today for our market strategist, Jessica Amir. And today we're once again looking at huge moves in the US markets. And unfortunately for investors, they were negative moves in overnight trading. After that huge surge in US markets in the previous session, we saw them give up some of those gains and pressure across all sectors in US trading. Saw the major indices pulling right back. Big pressure on the Nasdaq. It dropped by more than 4%. And the S&P 500, the most influential share market index in the world, dropped 3.5%. I'll bring up that chart because I think it's important to have a look at the chart of the index to see just how much movement we've had over the week. And it's interesting to think it's only been 7 trading days since the introduction of tariffs by the US. But this chart shows what a massive impact that change in the global outlook had on share markets, because this line chart of the S&P 500 shows the trading week. And from the chart, you can see on the right-hand side the percentages of the moves over the course of the week. And the S&P 500, one of the most valuable and the most influential index in the world, has traded through a 14% range since the introductions of tariffs by the US. That's a huge trading range. It goes to show that we're currently in very unusual conditions. And the sell down was led overnight by the US tech stocks. The Magnificent Seven stocks came under particular pressure. One of the worst performing sectors was the auto sector, and one of the reasons for that was it contains Tesla, and auto manufacturers as a group were under extreme pressure, falling around 6%. Tesla leading that fall with a 7.3% drop in trading overnight. And now that the Tesla share price has more than halved, the question is being asked about dip buying, but the very vertical nature of the selling at the moment, Tesla, might give some investors good reason to be cautious about buying into it just yet. Nonetheless, the clear problem for markets at the moment is the trade tensions between the US and China, and the imposition of retaliatory tariffs on both sides of that equation has seen them rocket higher. And one of the sparks for last night's selling was the clarification from President Trump that the tariffs now imposed on China are at 145%. And of course, this is obviously an absurd level. At those sorts of levels, there'll be nobody making profit on exports to the US. And while these barriers, and it's very likely that China will respond with further lifting of the tariffs it's imposed on the US, with that sort of barriers between the globe's two largest economies, trade between the two is essentially at a halt until some sort of resolution of the issues are found. And that's what's really concerning the markets this morning. We did see the lifting of the tariffs over a lot of nations, or the reduction to 10% in most cases for many nations, but it's that potential for the two largest economies in the world to remain in conflict over trade that really is concerning markets and is weighing on growth. And we saw that feed not only into share markets in US trading, but also to commodity markets with pressure on the oil price. And let's just bring up that oil price so you can see it here. Now, this is a slightly longer term chart than the previous one, but that slide you can see on the right-hand side is the week's trading in oil. And although in the previous session we did get a bounce, that spike you can see at the extreme right of the chart, in overnight trading we saw a resumption of that downtrend. And that reflects overall very sour sentiment globally about the prospects for growth. While oil is on its way out to some extent over the coming decades, at the moment it still powers most of the globe. And when the outlook for growth is poor, the outlook for crude prices tends to follow, and that's what we're seeing on this chart. However, it wasn't the equity markets or the oil markets that really got movement from President Trump and his administration. It was, in fact, the sell-off in bonds that really seemed to catch the president's attention, and there's good reason for that. In 10-year bond markets, a move, as we saw over the course of this week, in 10-year bonds in the US from 4.5% to over 4.5% is huge in bond market terms. And given that the US was rolling over billions of dollars of debt in 10 and 30-year bonds this week, that big increase in interest rates on bonds meant a big increase in costs for the US government. And it's that cost that really finally appears to have gotten Mr. Trump's attention. And add to that the pressure that we saw on the US dollar. The first blush response to the introduction of tariffs was a strengthening of the US dollar. It was thought that investors would seek safe haven and businesses would seek to get behind the tariff walls, as it were, by buying US dollars and buying into the US economy. But that reversed this week. And in fact, the US dollar has come under severe pressure, particularly against the euro and the yen. And the drops again resumed last night. And it's that weakness in the dollar is a sign that investment funds are fleeing the US. And so that pressure on bond markets and the pressure on the US dollar seem to have finally had an impact where share market volatility was having no impact on the president's decision making. So bonds and Forex clearly ahead of equities in terms of their presidential influence. The problem for markets generally now, and particularly for global investors, is even if tariffs are lifted tomorrow, the erosion in trust and confidence in the US administration has had a lasting impact. And it might well be argued, and it's being discussed right now amongst those institutional investors, is how much risk premium should be attached to all US investments, whether they're shares or bonds or anything else, in light of the capricious nature of the introduction of tariffs and the concerns that it brings about, that the US administration is not to be trusted when it comes to international trade matters. And that risk premium could mean that we won't see US equity markets, for example, returning to the all-time highs seen just 2 months ago in the US for quite some time, as international investors continue to discount the sovereign risk that's been introduced by the White House with this introduction of tariffs. So we expect the selling to continue into the Asia-Pacific region today. Futures are indicating a very weak start across the region, although Hang Seng futures, which closed earlier in the night session, are only down 0.5%. We're seeing a 1.5% drop in futures over the ASX 200, and Nikkei futures are even affected even worse. The fall there, the opening fall, as predicted by the futures markets, is expected to be 3.5%. So under those conditions, it does look like it's going to be a tough day for local investors. Just looking, however, at one bright spot in the investment markets at the moment. On this chart, we've got the gold price, and as you can see, it did dip, particularly as that US dollar was strengthening. But with the US dollar weakening and concerns continuing about the global trade outlook because of the tensions between the US and China, we've seen gold resume its leadership. And in fact, it surged back to all-time highs in overnight trading. So many investors enjoying the benefits of being diversified where they've included gold in their portfolio.